and more with our next guest. We have Tushar Pradhan, Director at HXGON Partners with us. Tushar, thank you so much for joining in. So, tell us exactly, and you've seen this play out in multiple stocks across sectors. This is not just a trend story, right? This is about the market bidding up something where it finds growth. And in India, fund managers typically love growth. And then when that growth has to be, those expectations have to be reset, which is what we're seeing in trend, sometimes it can be quite painful. How would you navigate a situation like this where perhaps the underlying business is still okay, but it's about expectations and delivery?
I think you hit the nail on the head exactly in terms of what the expectation of valuations are indicating. So if you're trading at 70 times, 80 times, essentially the expectation of the market at that value is that you're growing at 50% earnings growth at least. And as you know, businesses are not really that predictable. So even if you have a quarter of not so much of an exciting growth as is estimated in the valuation, you will suddenly find that incorporating even a smaller percentage of a lower rate of growth is going to collapse that stock, because that is what gets automatically incorporated in the future valuation. So I think the real alarm bell around valuations is that it is going to become extremely volatile if you hold on to stocks which are, upwards of 70 times, etc. of earnings, especially of businesses which cannot really grow at that rate. So when we are talking about, as you just mentioned, retail, I don't think the rate of growth, given the constraints around how you can actually expand that business, is just going to be blue sky. But as opposed to, say, something like a service offering, which doesn't have a constraint on capital constraint or a capacity constraint, then the growth can be really electric. It can be really rocket-like. But that's really where the excitement comes in, that it's not one size fit all to say 70 times is expensive, so avoid. 70 times based on what expectation, what delivery, and the ability to deliver a very strong rate of growth for a significant period of time is really what distinguishes valuation. It's not the number.
No, absolutely. And that's beautifully explained, Tushar. Let me try and apply this to another scenario. Like I said, the problem is the same. The sectors or the companies or the stocks could be different. EMS. And we saw this scare play out when Dixon's numbers came out, right? There was nothing wrong with the numbers. We all know the margin profile. We know the business. We know where all they're expanding. But it was the same situation. Here's a company that's, that's trading at a stock that's trading at almost 100 times. So you said in trends case, or companies which are in the retailing space, maybe continuing at 50% growth is not possible. What about EMS?
Here also, I think there is a significant amount of money that you're required to expand, right? So for example, if you are into the EMS space, you will require facilities. Orders is one thing, but your ability to deliver an expanded base of products, it's not going to come overnight. And if you have invested in it, it is going to take a long time before it comes online. Essentially, the market is a little manic, which means that it starts to incorporate what the potential for a company is, maybe 2 years into the future, already in the price. And given, I would say, buoyant capital markets, it is likely that those kind of multiples may sustain. So it is not about being scientific about it. It is also being very conversant with what the sentiment is. So just let me give you a simple example. So for example, if you have significant foreign inflow of capital coming into our markets, company trading at 100 times, delivering on earnings growth, I don't think the multiple will get damaged too much. But just change the scenario. The overall underlying fundamentals remain the same, the delivery continues, but the sentiment changes, you will suddenly find a 20-30% drop in any 1 month or so. I think this is really the vulnerability that you're talking about. We are assuming that the fundamentals of all of these companies remain very, very solid going forward, but yet they will have valuation risk.
Absolutely. Guys, that's a lot of food for thought, isn't it? I mean, the Indian market is so peculiar. You have a company of a result, 30% top line growth, 35% PAT growth, margins at 18-19%. You'd say, what's the problem? Stocks selling off 8-9% as if, skies fallen down. But that's the Indian market, I guess, for us.
Well, that's also the market where you had an 7-8% fall at the beginning of the week just because one fashion app got launched in an online format. So it's been two body blows for Trent this week as the stock has corrected close to about 15%. But BEML, that too reported numbers. Again, a case of, high growth expectations, high valuation. a fantastic stock run-up, but stock is unwinding today. Sharp sell-off now, 3% gone. This month, 15% lower. Revenues for the company de-grew by 16% on a year-on-year basis on account of likely execution issues in metro and mining. Profits are down 49%. Gross margins have slipped by 220 basis points. Tushar, afternoon, where do you stand on the entire Capex theme? So break it up for us in terms of power, industrial, defense. Do you have a preference, or is it an avoid because of the volatility in earnings?
No, in fact, I would have a reverse view on this, that one needs to be invested in the Capex cycle going forward. We have not seen one for a long, long time. And the current one, which will be coming, one has to be patient. One has to be very circumspect in terms of the entry points, because I think everybody understands that there has been a lull in terms of the government Capex, as we saw in being an election year, etc. But that's going to pick up. If you see the kind of commitment in the budget, all of that is following through. There has been a lull. As a result of it, there is going to be a lot of slack, which is in the current spending, which is actually going to come through into the numbers. And essentially, it will start falling in place. Currently, I think we are in a very, I would say, in-between situation, a transitionary phase, where the expectation of growth is so urgent into every quarter that there needs to be, a balanced look at what's going to happen. But if you were to ask me for the next 1 or 2 years where I would like to put my money in, clearly I think Capex plays. And I think, as you mentioned, there is an entire spectrum there. And essentially, a Capex cycle works over the period of time, and different kind of companies involved in the Capex cycle starts to do well over a period of time. So process industries, things which start from day one, are the ones which start to benefit initially. So we are talking about companies which make process machinery, even components going into it, even metal. Once the factories are up, then you have other kind of manufacturing which starts to build up as a vending, or let's say a vendor chain, a supply chain into the manufacturing process going forward. So there's another slew of companies which start to do well. And once the capital cycle is complete, then you have the actual OEMs, or I would say the companies who actually put the capacity up, start to make the upside. So you have a very interesting period coming ahead of us in the next 1, 2, or 3 years, where you'll see this entire Capex play work out. So I would be very, very optimistic about the whole cycle here.
Okay, all right, Tushar, thanks a lot for joining in and filling us in with your take on the markets and how you see things getting positioned as we go ahead as well. By the way, the markets were